As inflation seems to stubbornly continue to soar, retirees are facing economic hardships when it comes to spending their hard-earned savings. And what's the Federal Reserve doing? Well, it's trying to battle it, but will it be able to move the needle? To help us today on this also important topic, let's talk to Eddie Ghabour. He's the owner of Key Advisors Group in Delaware. He's also Amazon best-selling author of the book, The Common Sense Bull. Eddie, always great to have you here on The Income Generation.
Thank you for having me, Dave.
Yeah, so gosh, what do we have going on today, right? We've got inflation. We had negative economic growth in the first quarter. The Fed raising rates. We have war. China shutting down the economy. What are the two things on that list I just gave you that you find are getting your clients' attention the most when they call you on the phone or they come in and see you?
Inflation is absolutely top of mind for everyone. I think that is the number one issue that has people concerned because let's face it, it's been 40 years since we've seen inflationary data come in like this. Some folks have never lived in that world before. And so it's very scary for people. The biggest thing that's scaring them, and it's the reason why the markets are breaking down, is the rate of change on how fast it's doing it. I mean, it's accelerating at a huge rate. And I think this summer is going to be a very, very tough summer for the consumers and this economy.
Yeah. To see the CPI index come down, we probably have to wait until the fall. Everybody gets through the travel season and so on. So, all right, that's part of the equation, right? The inflation, but then we've got this fear of recession, which seems to be accelerating also. So that puts us into a possible stagflation scenario. How likely do you think stagflation is, where there's an economy that's not growing, but you still have inflation?
I think we're in it now. That's the direction we're heading in. Look, this economy is it's fragile at best. I think the Fed is completely miscalculating the strength of this economy. In my opinion, we're going to have a recession sometime in the first part of next year, the technical definition. But as you well know, the damage is going to be done well before then. So that's the direction we're heading in. And I don't think any monetary policy is going to change it because the momentum is already heading in that direction. And it's going to be very difficult to stop it.
Yeah. So if you have stagflation and you go into a recession, but inflation persists, then what does the Fed do? Do they lower interest rates to make inflation worse? Or do they just let it go and take the course? I mean, at some point, it's got to take its course after all this manipulation, all the printing of money we saw after the financial crisis in 2008 for about 6 years, and then for 2 solid years after the beginning of the pandemic.
Look, this is the price you pay when the markets and everything turn into the wild, wild west and there's loose money and borrowing money. This is the price you pay. And this is why I've been telling individuals, this is the worst scenario setup you can imagine for a stock market perspective, where you have very high inflation. The Fed is forced to tighten during an economic slowdown. And I would argue we're looking at a global recession that we're going to be heading into. So this is a very, very treacherous time period. And this is not time, in my opinion, to try to be a hero and take a lot of risk, because I think things are going to get a lot worse than most people walking around actually realize.
Do you think we can end up with a situation like we had essentially in the 1970s, except for maybe interest rates won't go as high because we're not coming off the gold standard. We've been off it now for 50 years. But do you think it could be something kind of sort of like that?
It certainly could, in the sense that if the Fed decides to just put their blinders on and ignore the economic data and ignore the markets and just continue to raise rates as aggressively as the bond market's pricing in, that's what will happen. I personally believe the market's going to call their bluff at some point in time this summer. If it's down 35%, I find it hard to believe that they're just going to tighten into that. If they do, God help us all.
Yeah. Well, they probably 2 more tightenings, 0.5%, and then they sit back and they let it bake and see what happens. Which the good news is still puts Fed funds rates below where they were in December of 18. So it's not catastrophic if they're smart enough to do that. So you said, it's not time to be a hero. So how are you being a hero for your clients by not trying to be a hero, as you put it?
Well, Dave, you know, and it's been a long time since I've been bearish on the markets. We came in the fourth quarter of last year, warning clients that 2022, the name of the game in 2022 is going to be playing defense. So we have raised cash. We have sold out of some of our higher beta plays in our tactical strategy. We came into this year, we have zero technology exposure, zero small cap exposure. Right now, we have zero international exposure. This is the most defensively positioned our firm has been since we started 20 plus years ago. Because right now, the number one objective, our job is to protect capital. That's my opinion, not trying to grow it aggressively, because I just don't see the risk reward worth it. Now, towards the end of this year, we may have some buying opportunities of a lifetime. But for now, we're just going to continue to sit on the sideline and wait until this thing bottoms.
Mm-hmm. So how about folks that are in a 401k now, they're going to retire in 10 years. They've got most of their money in, typical mutual funds, most of which are stock mutual funds. Maybe they don't have a lot of money on the sidelines. What do they do?
So look, I think that they need to reassess how they're allocated. I mean, if you're close to retiring, do the math. If you lose a third or 50% of your portfolio, you may not be able to retire in the time period that you expect, because the math tells you how much more you'd have to grow once you see that loss. And something that's a very dangerous mindset that a lot of investors have right now is they think that the worst is over and what could possibly happen, I'm just going to wait till it comes back. Well, what if it doesn't? There are some companies that are going to go to zero, in my opinion, because of how treacherous this environment is. So it's never too late to de-risk, in my opinion, when you have a market like this that could go down another 10 to 20% from here.
Yeah. And what a lot of people, I think, don't even realize is that today, at least, most 401k plans, they may not have a lot of options inside of them. Some do, but there's usually some things you can do within there to de-risk. And for a lot of folks, if you're at 59 and a half years old or older, you can do an in-service rollover. You can literally roll the money over to an IRA, where now you're not just limited to a bunch of mutual funds. The world becomes your oyster if they're working with an income specialist like yourself.
That's exactly right. Look, I'm always a believer that there's always a way to try to accomplish what you're trying to. You just sometimes have to be more resourceful than others. And the 401ks definitely make it challenging, to your point, because it doesn't have as many options. But there's still places to go to try to preserve capital and at least make the damage not as harmful as it would be if you do nothing. And a lot of people freeze and do nothing when the news is bad. They're afraid to look at it. And that's not the right approach. Yeah,
I think that right there is the most important piece of advice. Don't sit on your hands in a market like that. Do something. So Eddie Ghabour, great words of wisdom as usual. Thank you for being with us here on The Income Generation.
Thank you, Dave. It's my pleasure.
Thank you for watching today's market update video. If you enjoyed it, click the thumbs up button to give us a like, and make sure you subscribe to our YouTube channel for new content each and every week.